Hello and welcome to today's webinar, Navigating US Sales Tax, Next Steps to Market Expansion. I'm Kelly Miranda and I will be facilitating today's session. Today's presenters are Michael Bernard, Chief Tax Officer, and Larry Mellon, Senior Tax Director of Vertex Inc. Please direct your questions to the Q&A tool on the bottom right of the screen and we will address them as time permits. I will now hand over to Michael.
Thank you very much, Kelly. Good to be with all of you here this morning, this day. Larry and I enjoy these sessions, particularly for our European colleagues, and to offer you some more learnings around U.S. sales and use tax. We've offered a number of seminars in this, so this is kind of building off a little bit of some of the basics of what we've done before. So a little bit more of an expansion, some further ideas and some things that we want to talk about here today. First and foremost, just myself. I was, before I came to Vertex about 6 years ago, I was the U.S. Tax Counsel and General Manager at Microsoft Corporation, essentially led 3/4 of that tax department, everything from direct and indirect tax to the tax stack to property taxes. So just a wide various of functions. Came to Vertex to actually do a little bit of a different role, traditional role than tax, was to bring software and services to this community. So have enjoyed that very much. Our Chief Tax Office is actually about 4 or 5 people, including Larry. And we put out about 120 pieces of content from blogs to YouTube channels. So you'll see that at the end. And if you enjoy the webinar today, there's various other places where you can connect with us later. Larry, a little bit about yourself, if you would.
Thanks, Mike. So my name is Larry Mellon. As I said, I'm the Senior Director of Global Tax in the Chief Tax Office. I'm at my 20th year at Vertex. I have used the Vertex products for 35 years, plus 35 plus. Prior to joining the Chief Tax Office, I was the tax manager for Vertex, doing our actual taxes. So I was a customer as well. So I have an understanding of the attendees that are on here with doing the compliance. So it's great to have everyone here, and we're looking forward to having a great program today.
Yeah, thanks, Larry. Just a little bit before we dive in, just a little bit on the agenda. Larry and I want to spend a little bit of time, first and foremost, kind of recapping some things that we did in our Sales Tax 101. So just some concepts there to kind of lead us into some further discussions. Then we want to jump into what compliance determination and some reporting looks like and how often you have to do that here in the U.S. states. Exemptions is always a very important component of your obligations, your compliance obligations. So we want to spend a little bit of time on that. And then we have a program, which I know you have somewhere in the VAT area, is what's called voluntary disclosure agreements. And so these are places where if somehow you should have been filing somewhere and you didn't, and that's for a period of like a year or longer, you actually can go to the states and actually receive some relief in terms of filing for the back years, and then obviously moving forward and being compliant there. So we do want to spend some time on that. And then lastly, there's about 10 items that I want to cover that are emerging issues that we're going to talk about, at least in the US states, and some things that I think you might find interesting. With all of that, I think we'll go to the next slide. And Larry, if you would, please.
Great, thank you. Thank you, everyone. So just to kind of, as we said, we're going to kind of give a review. What we determined last time is we really started to dive into transaction taxes. We talked about a sales tax and a seller's use tax and consumer's use tax. We basically went through and talked about what type of taxes they were and how they affected U.S. businesses with assessing or assessing yourself or being assessed on the sales side, or basically how you handled on the use tax side of how you handled tax for invoices that did not have tax on it. So we kind of went through the structure of what they were. Then we went through just some basic concepts of nexus, right? Where primarily in the past it had always been a physical brick and mortar type location. But we started talking a little bit more about how things had changed, where economic nexus, right? For marketplaces and where services are performed, where the benefit of the use of something. So we went into that level. Then we talked about rates and regulations, about how some of those are determined and how they are maintained. We did do some compliance and reporting, and that's why we want to drill a little bit deeper into that area this time. And Mike's going to talk about those last two, right, Mike?
Yeah, I do. So I want to just mention some things up front that I think are very important for this group to kind of keep in mind. First of all, the second to last item, we get this question from a lot of our U.S. colleagues about whether there's ever going to be a U.S. federal sales and use tax or VAT tax in this country. For the last 25 some years, there has been a bill in Congress. You can go look at it, but it's called HR 25. So HR 2525. And it would impose, if it were ever passed, it would impose a 23% sales tax. So it wouldn't look like a VAT, it'd be a sales tax on most goods and services in this country. That bill has no chance of passing today. We're still going to continue to rely on, principally in this country, on the corporate income tax, the personal income tax, and Social Security tax. So you're not going to see anything like that coming up. And if you go and you look at that bill, it'd probably take you about 3 minutes to read it, and you get a sense of what it actually is. The second to last, or the very last item, is I want to talk on e-invoicing. E-invoicing obviously has its roots, or it started both in Brazil and Mexico, and now it's greatly extended into Europe. There's no chance of e-invoicing actually coming to this country for a couple reasons. One is, first of all, the sales and use tax compliance rate here is pretty high, and so there's not a need to actually kind of digitize and actually use that as a way to actually kind of drive compliance. So that's one thing. The second thing is, most of the state leaders who run the Department of Revenue, so in places like California, New York, or Florida, or Texas, they don't want to actually implement a system like that. To be honest with you, they're seeing what's going on in Europe and all of the different approaches that the different nation states actually have as it relates to e-invoicing. And the one thing that they would want here is uniformity around, that reporting. And since that doesn't seem to be, or it is a challenge, and it's going to be eventually achieved, hopefully, in Europe, but they don't want to actually take that on right now. So given the fact that compliance rates are pretty high here, and they don't really want to change the current system that they have, that is kind of where we're at with e-invoicing. All right. Okay. Next slide, Larry. Yep.
Okay, so we have our first polling question. So to help us kind of frame how we want to dive in and talk about these, what is your level of U.S. sales and use tax knowledge? So you have none, a basic, an intermediate, and advanced. And it will just kind of help us. We know that we had talked primarily about sales and use in the beginning, but this will give us an opportunity to determine to what level we need to have our discussion with you.
And Larry, I think last time that when we've done these, they've kind of fluctuated a little bit between basic and intermediate, right? For the most part.
I would agree. Yeah, and I'm thinking we may end up in that same range this time. Not sure. Yeah. Okay, so why don't we see what the results are for this? All right, so none to basic. Okay, that's okay, interesting. All right. So that helps us kind of frame out where we want to go and stuff like that.
Yep.
Yeah, that's good. All right, so we'll move
Thank you.
on.
Thank you, everyone. Appreciate that. Mm-hmm.
So let's talk a little bit more about the compliance determination reporting. So like I said, remember we talked about the basic concepts in the first one. So now we're going to go a little bit past some of those basic concepts. So hopefully for those that are at the basic level, you'll understand some of this information. But registration, we talk registration, maybe a little bit different in the US versus some other countries, right? So, when are you required to register, right? What took place that made to do this? Some businesses will look at it and say, I have taxable transactions, so I had to register. Others just say, because I have a business, I'm registering to be able to do that, right? So when we say register, it's, register to be able to assess a customer tax, to be able to collect that and remit that, as well as if a customer gives you an invoice and it has incorrect or no sales tax on that invoice, you have the ability to self-assess and remit use tax to that taxing jurisdiction as well. So when we went through that in the breakout before, we talked about that physical presence, right? So a question you have to ask yourself in registration is, do I have a physical present, physical entity, right? Do I have brick and mortar? Do I have to register because I'm there? And then you're going to look at it and say the whole economic presence. Back in 2018, the Wayfair decision in the US started looking at determining economic presence and how you had to register, collect, and remit in those taxing jurisdictions. So you have to look at it and say, how is my business structured? Do I need to register, and how am I registering? Is it physical or is it economic? And then I always look at it and just kind of say, you have to be able to track that, right? You got to be able to look and say, how do I know where these sales are? How do I make sure that I'm assessing correctly once I register and remit and on each of those things? So all of that goes into the registration process just to make sure you have everything in line before you start producing any activity of your business. You want to have that information aligned. Next is like ERP data and a tax engine, right? Two key things that most businesses use, but we have to make sure that these work together, right? We know that if you do an implementation, right, you have your ERP system. Often the ERP system is put in place to multiple things to run the business, to use in many areas. But the piece that has to pull into a tax engine that's either going to help you assess correct taxation, right, before you invoice, you have to have a successful implementation, whether it be on premise, whether it be on the cloud. You have to put that information in there so that it reads that information. The part, product, SKU, whatever you're using on your ERP data has to match what's in the tax engine so that it reads apples to apples and produces the correct taxation, right? So you have to make sure that that ERP system is going to work for you. It's going to be able to give you that correct information to make sure that you can put on your customer's invoice the correct state, local taxes, and any fees that are on there. It has to be able to go to a detailed line level and assess taxes across the board for those. So it's key that you have that in your determination. When we talk a little about reporting, you have to make sure that that taxation is calculated correctly on that invoice, right? As you're doing that implementation, you're going to be doing some checks and balances to ensure that you did create an accurate invoice with accurate tax that's on there. You don't want to be issuing this to a customer of yours and not have the correct information on there, whether it be the determination of whether it's taxed or not, or what is the correct taxing rate to use based on where those services are performed or where that product's being delivered or used. You have to make sure you go all through that in your reporting information. And then once those reports are completed and you've done those reports, you've assessed your customers with invoices, you've collected that appropriate amount, then you're going to remit that information to that taxing jurisdiction. All of those reports should all be audit ready, right? We're going to talk in the next slide or so. Yeah, or actually here we'll talk a little bit more about it. Every 3 to 4 years, generally, businesses will get audited by particular states, right? The determination of when you're being audited is going to depend on the activity. What has been a trigger for a U.S. audit also comes up, right? So it could be you're buying from someone who did not put the correct rate on there and that triggered an audit. You've put the incorrect tax or tax rate on an invoice of yours, that potentially may cause an audit. But these audit-ready reports and the reporting and the notifications of audits, you have to have that information aligned. And what's also key for the U.S. and other countries is that you often have exempt sales, things that qualify to be exempt. And we're going to dig a little deeper on the next few slides on exemption certificates, but making sure you have documentation to back up those exempt sales is what's really going to be important, especially because that's one of the things that an auditor is going to first look at, is to look at those transactions that you've had taken place that did not have tax assessed on them. They're going to look at all transactions, but if a transaction has tax on it, the jurisdiction has received their money, they're going to spot check that. But they're going to be more interested in those invoices that did not have tax on them.
Just a couple things there, Larry, before we move on. Just kind of moving up back on the registration piece. A couple things that I wanted to note is, so Larry mentioned that the physical presence test is still here in the U.S. and for U.S. states. So again, if you have an employee or an office or a warehouse or some physical or property that's in some state, there are no economic nexus standards that apply to that. You have to actually collect and remit based upon the fact that you have presence there, physical presence there. If you don't have any physical presence, then the economic nexus standards kick in. And I want to make sure that we understand one thing that's very key, because when the Wayfair decision was passed in 2018, there were economic nexus standards that were put forth by the states over the next several years. So based upon, say, California had, if you sold $500,000 worth of goods in that state, you had to start collecting, remitting. Whereas other states, it might be $200,000 in US dollars or something like that. The one thing, if you get out of this webinar, and you'll get a lot of things, but the one thing you have to absolutely make sure you do, and we have a link to this website in additional resources, which is the last page, which is on the last page of this deck, and you'll get the deck, is the fact that you don't have an obligation under the economic nexus standards to start filing once you hit, say a $200,000 threshold, if that's what's in a state. What a lot of times what this report is going to show you, or this guide is going to show you, is most states have a look back period. So let's say it's 2025 this year. You hit let's say just next month in May, you hit $200,000, and that's the standard. That doesn't mean you have to start collecting or remitting in 2025 in June. A lot of times what states will do is they'll give you kind of a grace period. And what they'll say is, if you have $200,000 in sales in 2025, then what you'll have to do is you'll have to start collecting and remitting in 2026. Now, Larry, you and I both know that each state has taken a different approach, right, in terms of when collection and remittance actually takes place under the economic nexus standards. And what we saw with a lot of our U.S. colleagues here is they just started collecting and remitting right away. You don't want to do that. You want to collect or remit when you're legally required to do. So make sure on the last page with the additional resources that you're very aware of when you actually should collect and remit. Okay, wanted to land that. All right.
Yep.
Go ahead, Larry, if you would.
Yeah, there's a few questions. I'm going to try to see if I could take a few from here. So as a UK-based foreign entity, can I register for U.S. sales tax in a U.S. state and ship goods from one U.S. state to another? If so, can I obtain a reseller certificate to simplify the process? So I'll start by saying yes, that you can register for U.S. tax, right? If you have, if you're going to be conducting business in the U.S., you can register and you can ship goods from one state to another, right? So you would be required to assess tax based on that state's regulations of, is that product or service taxable, at what rate you could do that. The piece about the reseller certificate is it's going to depend what's happening with that product that you're selling. Are you selling it to an end user? Or is it then being sold to a retailer who's then going to send it, who's going to then resell it themselves? Is it sent to a manufacturer who's going to build it in? That certificate is going to then depend based on that. Okay. The next question was, under how many years may they go back in an audit, or does this depend on the state? It depends on the state. It's generally 3 to 4 years that they would go back and look. And then will the physical nexus versus economic nexus, questions are popping in, change the tax calculation? No, it's either going to be taxable or not. The rate and stuff would not change based on that.
Good questions, Larry. Yeah.
As a UK-based e-commerce company, can we register for U.S. tax, collect at the point of sale, and then remit without a U.S. bank account? I would think as long as you are remitting it to the taxing jurisdiction, I don't think it determines that it has to be coming, the funds have to come from a U.S. bank. There are businesses all over the world that are moving stuff. But I would think it would be ideal to have a U.S. bank account, but I don't believe it's a requirement.
Yeah, it's not. That's an interesting question too. Yeah.
All right, so we're going to move on to our next slide. So a little bit deeper in the compliance and reporting, right? So Jack, the tax returns are generally filed every month, right? For most taxing jurisdictions, they want that each month, right? And all amounts should be remitted to the taxing jurisdiction. I put the word in here should be because, I don't want to say that there's a gray area. Generally, if you invoice a customer in a given month and you collect that amount, you should be sending that exact amount in. If there are differences that you have the opportunity to go back and work and pose a credit for a future period or take transactions and adjust them. But for simplification, for audit purposes, for book purposes, whatever amounts you collect should be remitted within that time period. It's also, when I talk about those differences potential, it's not uncommon for companies to set up reserves, right? If I know that I've overtaxed or I've undertaxed and I want to put money away in a reserve because I'm unsure if that's accurate, and I want to make sure that I have funds in there and recognize it in my financial portfolio that we potentially have this exposure. So whether it be for internal or your finance leaders are aware of it, so they're not coming at and saying, now I need a larger check because I didn't do anything about it or didn't recognize that I had potential exposures. And then for reporting, filing return generally falls for selling tangible personal property or the marketplace where it's sold. They're generally the people that are responsible at the end of the day for collecting remitted or for where it's coming from. And for the most part, reporting is done on a state basis, right? So Mike had talked earlier about the potential federal tax rate and stuff. Everything in the US is done at the state level. So most of these businesses, if you sell into the state of Pennsylvania, in the city of Philadelphia, basically you're doing a state of Pennsylvania tax return that shows the sales and transactions in that state, in the city, in the local areas. It pretty much goes on one return, and the funds that are then collected are then divided out by the state to those areas so that the locals all get their funds. And as we're going to talk a bit more about exemptions, I just want to talk about, often when people talk about exemptions, you must really have a well-documented system to track all the exemptions, because in the US over time, they've developed processes where these have expiration dates. So you must be aware of when that expiration date is put into your tax system with an expiration date. If you don't keep up on when that expiration date is valid and it expires, you'll then begin to start taxing your customer. And I really want to point out the word on here. I put on here applicable, because a lot of people look at it and say, I've given you a valid certificate, but it must also be applicable for the work that you're doing. If it's a manufacturing exemption certificate and you're not selling manufacturing pieces, then it would not be applicable to that and should not be accepted. Okay.
Just a couple thoughts on the second bullet point that Larry made, all amounts should be remitted. Keep in mind that once you, much like it is in the VAT world, once you collect an amount or assess an amount on a sale or something like that, you then become a trustee of those funds. So you have to remit them. You don't have an ability to actually hold those funds or wait for an audit. You do need to send those funds in. The second thing I want to mention is on bullet point number 3 for establishing accounting reserves. One of the things in our tax engine, and I want to make sure folks understand this, is there's this thing called levels of authority. And if you think about it, all of the rules that we publish in our engine, we have to have published guidance, whether that's through a statute or regulation or a private ruling or something like that, in order to collect or remit a tax. So we have to be virtually certain, so almost like 90% or higher, that we will actually collect and remit on something. There's going to be situations, and Larry, you know this, where you read the statute, and if you're selling a certain item into a state and you're not really sure if it's taxable or it's exempt, I think what most US based companies do and how they handle these things like reserves and levels of authority is they want to make sure that there's published guidance specifically on that item. And if you can't, then sometimes you just have to make your own call. But before you actually tax something or exempt it, make sure that you're somewhere up around 90% clear on the technical merits of whatever you're collecting or remitting and reporting. That would be the other thing. And then the fourth bullet, I would say, Larry mentioned there about tangible personal property. Most of you know that, or you'll find out, at least in the States, that tangible personal property, the general rule there is that it's taxable. We don't, or states and cities and counties don't widely tax services. About the only, and the reason they do that is for a number of reasons, but one of the places where Americans spend most of their money, they spend it either in healthcare or childcare or elder care. And so those services are not taxed, because if you did tax them, it would be highly regressive. There's about 7 states that actually do tax some services. And I think, Larry, what we've seen on the services side is that if there is taxation of services, it's normally in the personal care area, right? It's lawn care or cleaning care or something like that. So that's where you're going to see some taxation of services. And that trend is emerging. So you're starting to see states more and more tax those types of services.
Great. I want to go through a few. I want to go through a few of the questions on here. When is use tax applicable? Is it always when supplier invoice does not have sales tax applied? I would say that's the primary reason, but remember that also that supplier could have the incorrect tax on there as well. So both of those apply, but for the most part, it's when they don't have tax on there and you believe that there should be tax on there. Also, can you give a few examples of economic presence? So basically, if you are in the state of Pennsylvania and you are selling into the state of New Jersey, but you do not have physical presence there, but you're conducting business in that state, that's the economic presence. You've met, in Mike's example of 200,000 of transactions, once you've met that state's requirement for economic presence, then after that, you would then determine when you'd want to start doing it. So that's some of the examples of shipping from one, product from one state to the other. Let's see, we got a couple here. Are there best practices on how to document the exemptions? How can we make sure that the certificates are valid? So there are ways to document that. Vertex themselves and other people have solutions out there to track where you can put those exemption certificates that work with your tax software to be able to recognize when they're in the system to ensure that the tax, that vendor is set up with your company, so that when you set up a new vendor that you're selling, you determine the taxation of whether they're exempt or not. So any invoices that come out would not have it. So you would have to you have systems that could document that. And then how to ensure that certificates are valid would be primarily if a business gets a certificate that's issued by a state jurisdiction, it would be a valid certificate, right? You just have to make sure that it's valid in the fact that how it's being used for your company, that it is applicable and that the validity of it reflects to the products and services that that customer is purchasing.
Larry, just on that one too, there's normally in most states, there's a good faith exception, right? So if you receive a certificate and it has, say, what looks like a valid, like state issued number associated with it, with an address and all those things. And let's just say it's a company let's just say it's a state which generally has exemptions for agricultural products. So let's say seed or fertilizer. If the company you're selling to is a seed or fertilizer distributor or uses your products in developing those products, then your good faith exception would probably take over. But generally, what you will find is most auditors will actually kind of work with you in that area. But the one thing you definitely have to have is make sure that whatever you select, it's centrally managed, so everything goes into one place. Because for example, our exemption certificate will say, hey, they're normally good for anywhere from 1 to 3 years, right, Larry? And normally they will alert you as to when that certificate is actually going to expire. So.
All right, I'm going to move into the next slide, which we're going to
Sure.
talk about exemptions. So we'll dig a little deeper. So exemption certificates are issued, and received by businesses in the U.S. So basically what's happening is that if you're determining that, say, you were going to make a product, you were going to build a car, right? You're going to be buying all sorts of products from companies that are making the parts that are going to go in to build this car. You were going to be, as your business, you were going to work with your state taxing jurisdiction to basically tell them that you're going to be building cars and you would like an exemption certificate because you were going to be buying products from companies that you are not the end user. So the state will issue you a certificate that you will give to the person you're buying tires from, the company. And they're going to say, oh, okay, you're not the last person. You're building something and reselling this to a consumer. They will not put tax on that invoice because you've given them that certificate. And then when the car is completely built, you are then assessing tax at the final piece for the customer then have. So it's a little different than probably what you're used to hearing, that all of those parts, there's no tax paid on there. There's no value added to that. All those pieces of a car come to a manufacturer with no tax on it. And then once the car is complete and sold, then it then becomes taxable, right? So the factors they do is they determine that validity of the certificate. Like I said in my example, right? What is your business purchasing for these goods? Like, what are they doing, right? They're going to buy carpet and wire and motors and tires and everything that's for there, right? How does a company decide how they're going to use those goods, right? So if you think about, again, in the manufacturing process, you could be buying products that are used in your manufacturing process that aren't going physically into your product, but may be used up or consumed in the process. And therefore, they would also qualify. So it's understanding everything you're doing in that business to understand the products that we're buying to operate our business, whether it be in a manufacturing or I'm going to buy candy from the candy manufacturer and I'm going to get a resale certificate because I'm going to put it in my store, that my store is going to sell it to an individual for that candy bar, and then I'm going to collect the tax at that point. So all of these exemption certificates have to be validated with jurisdictions to qualify to get them, and then they must be given and received, and the validity and the applicability has to be determined when you get these certificates. So as we had mentioned, like an exemption certificate management system, right? So we have something like that. There's other ones that are out there as well. But keeping track of those certificates, when did I receive it? What is it being used for? Is it a blanket certificate and anything I sell to that company should not have tax on it? Or are there certain products that we're buying from that customer and we have to be more fine detailed to say, if I sell this to them, this is exempt. If I sell this to them, it's not exempt. These ECM systems do this and help you track where it's being taxed, how it's being taxed, plus what's happened over the past 15 years is the exemption certificates in the U.S. started coming with scrutinizing with more expiration dates. So now you have to manage the expiration dates so that you don't have one that you've received 20 years ago and just assume that entity is still tax exempt. By have the exemption, it gives you an opportunity to get a new valid and applicable certificate throughout your business so that you reduce your risk and exposure because you're making sure you've put the correct tax on there. Let me see if we have any. Okay, so I did an example of that. Got that.
Hey, Larry, just a
Yes,
couple
sure,
thoughts while
please,
you're
yes.
looking through the questions, if you would. So again, just to kind of recap what Larry said is exemptions generally apply to you always have to ask three questions. What is the purchaser using your product for? Okay, so if they're using it just simply to redistribute or distribute something, then normally exemption applies. If it's manufacturing, the exemption applies. Those are the situations. The second thing that often happens here in the States is if you sell to non-exempt entities, right? So like school districts or nonprofits or things like that, generally their certificates are valid because they're not taxed as a policy situation. And then the one that kind of causes a lot of issues for our customers, and Larry, you know this, is sales tax holidays, where generally in the fall or in August or sometime like that, when children are going back to school, a lot of states will exempt things like backpacks and computers and calculators and all kinds of things that those children need in order to go back to school. So those things may be exempt for, say, a month or so. So in other words, you would have to make sure that you turn on or off those exemptions for a particular period of time. That would be another situation that you have to be mindful of. So.
Correct. Great. Thank you. All right. So I got two questions I'm going to go through here. Is exemption certificates applicable for any goods that are resold? Meaning, is there any restrictions? Does this also cover services? So when you say restrictions, generally it's not. I mean, pretty much, like you said, that you're taking it in good faith. You've gotten the certificate issued by the state taxing jurisdiction. They pretty much know what you're using for. As long as you're using it appropriately, then it would be valid for that. If you're using it in a way that's not what it was intended for, then again, it would not be. And does it cover services? Most of the time, exemption certificates are for tangible personal property. It's very rare that a certificate would be in place for any services.
Yep.
And we have another question, pretty long one here. Let's see. So if a company sells car tires, they have to assess each sale to determine whether the customer is the end user or will be using it in manufacturing. So they have to ask the question, i.e., is the person just buying it to put it on their own car, or are they a manufacturing company buying parts to then build a car? So basically, you have to ask every customer, why are they acquiring? So yes, if I'm in the business of selling tires, do I have a retail location where I'm selling them right to a consumer coming in to put them in their car? Or do I only sell to manufacturers? So yes, you as a business have to accept that certificate for those that are doing it in a resale or a manufacturing, or you have to be able to assess tax, if applicable, for that tire in the taxing jurisdiction to an individual. If exemption applies, then no obligation to register. I'm not quite sure if I understood it. If an exemption applies, then you have to register for that exemption. So I'm not quite sure if that's clear. All right, we're going to move on to the next thing. We'll address questions as they come in. Our next is
I think there, Larry, just one thing I think is once you have an obligation in a state to actually collect, remit, and report, that's when your exemptions kick in. But until that, right, say if you don't have physical presence and you don't meet the economic nexus standards yet, then no, you wouldn't have to do that until you're actually required to actually file with that state, correct? That's what I think that question seems to indicate.
Yeah. So our polling question says, does your company have customers or operations in the U.S. where exemption certificates might be relevant? Simple yes or no. And then we have another question in on exemptions. So once we get some people responding into this, then we'll move and we'll go to that question before we move into our next section.
Yep.
Give another second or two, see who else is replying. Simple question, yes or no, if you have these in here. I think we're going to move on at this point and see what the answer is. Okay, so yes. So a good amount of people who do have U.S. operations, have exemptions. That's good. That's good to see that. All right, well, before we move to the next one, I just want to get this question. If exemption certificate is not provided by customer in time and quotation is issued to customer with tax, but during building, if exemption certificate is submitted by customer, then it causes the difference in tax determination in quote versus invoice. So how can we better manage this situation? I think managing it, yes, this does happen all the time. Certificates are then issued after an invoice is out. There is a process that you go back in and you can reverse that initial invoice, put the exemption certificate in place, and then reissue it with the appropriate taxation. So that does exist. Yeah. All right. So let's move on to our next section, which is voluntary disclosure agreements.
Okay.
And Mike, you're going to talk about this?
Yeah, I wanted to talk a little about this. One of the things that I think we found post Wayfair decision, and we also still see this widely used. So this is something that's widely used here in the States, are what are called voluntary disclosure programs. But what they ultimately get down is what we call these voluntary disclosure agreements. And so normally these things kick in when, say, you have an obligation, maybe you had a physical presence in a state, or you met economic nexus standards and you just simply didn't actually, understand that or realize that. And so there are opportunities to go to the state and actually become compliant. And normally what happens here is there's kind of two different ways to do that. First of all is what are called statutory VDAs. So places like California, Connecticut, they actually have a place in the statute where you can come forward. You would come forward and disclose what you believe your liability is. When you come and you do that, you normally have to be prepared to say what the liability was, say, in the past, and we'll get to somewhat about how these programs work. So you'll want to have some documentation that's pretty good, because once you enter into or you try to propose a VDA, you can actually you're going to just have to understand that you're going to be audited on that. The other one is what's called a non-statutory VDA, and these are in places like Maryland and New York, where actually you work more with, in both cases, you're going to work with the Department of Revenue, but normally you contact a person who's identified on their website, or your accounting firm would know who this would be in those jurisdictions as to who you would contact, and actually work through and there would be a specific VDA that you would work through on more of a personal basis. I do want to mention just a couple of things that are attributes of the VDA, or actually where you would actually use them. So there's always going to be a look back period, again, as we mentioned before. So if you come in and you say, hey, I should have started filing in 2024, one of the first things the states is going to ask is, okay, normally our programs say we go back 3 to 4 years. They don't go back 10. That's not what they're trying to do. The whole purpose of the VDA is to try and get you compliant and get you moving forward. So they'll go back 3 or 4 years. So you have to be prepared with documentation around that. The second bullet is, in most cases, the reason you even enter a VDA is because oftentimes you have tax that's actually required to be, remitted to them. You'll always be charged interest, but Larry, as you know, a lot of states, if you come in on a voluntary basis or use their programs, they won't apply penalties. Most of you probably know that penalties can range anywhere from 10 to 20 or 25%. So that actually kicks up the cost if you don't enter a VDA. So that's something that you'd want to do. The other thing I want to mention to you too is the third bullet is that if you do enter a VDA and if you register, so in both cases, if you're a newly registered person, oftentimes a VDA will kick off either an income tax audit or a property tax audit. So the state will say, hey, that's great. Thank you for coming in. And we see you're going to start giving us collecting or remitting sales tax. But we also want to know if you met the nexus standards for income tax, or if you had any property here and you should have been paying property taxes. So that will normally comes with the program. Those programs, as well as both income tax and property tax, those can be part of your VDA as well. So you would pay the tax, pay the interest, but normally penalties wouldn't be associated. And the very last thing that I want to kind of mention to you is this, and we used this extensively when I was in industry, is whenever we bought a company, we would take a look at where that company was selling their goods. And we would always try and look at and see if they actually properly remitted sales tax, because we saw that was normally where we had an issue. And if they did, then what we would want to do is file a VDA and actually have them pay that tax, because in many provisions, when you actually acquire a company, there's these things called clawback provisions. So let's just say that you acquire a company. Ultimately, it's determined that they should have paid $1 million in sales tax to, say, 5 different states. The purchase price is then reduced by that $1 million. So that's part of the value that the tax department actually adds when you actually do your compliance checks on these companies. Any questions on VDAs, Larry, that came in or not? Are we good? Good so far?
Going through, I'm just going to try to read them in order to keep up on them.
Sure.
So there may be one or two before VDAs, but there are VDAs. So let's do a couple of questions here. We'll try to knock some of these out and stir some stuff. So, is it possible and legally compliant to note on the invoice for customers with exemptions that is his responsibility to wear for sales tax? You can. There are customers who put on there saying that, in Mike's terms, like we've always talked about how we've accepted these in good faith. You could put something on there that if for some reason the taxing jurisdiction or under audit, they don't accept or believe that exemption certificate is applicable to what they're buying, you could put that on there so that then they be responsible for the tax if it was to be assessed to them later because it wasn't valid. Is software treated as a service or TPP? That certainly varies by taxing jurisdictions.
It does. Good question.
Yeah, and how the software is being delivered, right? Is it something that's TPP where you're getting a disk that's coming? Are you getting it? Are you hosting it in the cloud? Is it on your premise? Stuff like that. So a lot of that, that's a very lengthy conversation, but it's treated as both depending on delivery, use, and jurisdiction. Does a company have to be sales tax registered before applying for VDA, or can VDA payments need to be made before obtaining the registration? So normally, like in Mike's case, when he was going through his examples, he was talking at the last bullet about acquiring another company. So you're basically going to probably be setting up to do the registration to be in business for this new entity. So you may be applying for a VDA, and in Mike's examples, they may not have been filing stuff like that. So for the most times, you're not filing a VDA until you're registered to do business, so they know what entity is doing this. But that's the more common way that it's being done.
But I think too, Larry, sometimes what we'll see too is companies will go along for years and years and they're already registered and they're reporting and reporting. And then they look back, and you talked about reverse audits. They may go back and find something where they should have been collecting or remitting and they didn't. That's still appropriate for a VDA as well, correct?
Yes. Yep.
Yeah.
This next question. I'm going to skip that one. Super, super lengthy. Software is subject to U.S. sales and use tax in some states. Would the resale within U.S. trigger economic nexus for EU seller in the middle if it is selling business to business? Let me see. Software subject to some states. Would a resale within U.S. trigger economic nexus for? Well, you're saying that in this question, we're saying that software is subject in those states we're talking about, right? Would a resale, generally the resale would be between U.S. entities. There wouldn't be a resale from a EU seller to the U.S. because the taxation is on the U.S. side. So would it trigger nexus between the EU seller in the middle if it's selling business to business? So the EU seller would have to make a determination if they are doing business in the U.S., right? They would have to follow that state's rules that would determine, is that EU seller responsible for registering to collect and remit tax? If that EU seller doesn't meet those thresholds, they would be issuing an invoice with no tax on it because they haven't met that thresholds. And then the US company would have to look at that and determine if use tax was required because the products that they were buying from an EU seller were actually taxable in the US. And hopefully
the other kind of component on that too, Larry, yeah. Just another pivot on that too is sometimes taxpayers, when they sell, let's just say you sell exclusively exempt sales in a state, yeah. And sometimes the question becomes is, let's say I don't have physical presence there, but under the economic nexus standards, let's just say you have $1 million of exempt sales and no taxable sales. Oftentimes, even in those situations, and you have to look at it from state to state, even exempt sales will trigger the fact that you have economic nexus, and that you would have to you'd have to report all of those things to a state, because one of the things the states are doing is they kind of collect all this information, and whether you're selling on a marketplace or it's exclusively exempt sales or they're taxable, normally all of those things are bundled up together to whether you meet the economic thresholds in a state. So that was a good question. It had a lot in it. So
Yeah. So another question was, do they ever waive off interest liability in a case of genuine error which resulted in non-payment? Generally, I would say that if something is found that you did something in error, most times they will not waive off the interest, but generally there's an interest and a penalty that's being imposed on that lack of reporting and stuff. So generally they would waive off the penalty in most cases, but the interest generally stays on.
Yep.
What about where the nexus has been breached, but there is not taxable service provided, only nil returns are needed? What about where the nexus has been breached? So if you have breached where you have both physical and economic nexus, but they are non-taxable services, you still have to do the return with showing the non-taxable services and zero to at least show what the taxes were.
Yep.
We have a physical nexus in New York, and we have an employee in PA. Question we have is physical nexus in PA. So there goes into some of your talk of income tax, right? Like if you have an employee that's physically in Pennsylvania, you may not have a physical nexus for sales tax, but you probably have a physical nexus for income tax, that you have someone residing there.
Yep. Good.
Let's see. Additionally, so it doesn't, okay. So that's it where we have the questions. So let's go on to our next slide. And okay, another polling. In meeting your compliance obligations, meaning your tax return filings, for the transaction tax space, both VAT and sales and use tax, what model does your tax department deploy? Do you mostly handle this type of work in-house where you do it yourself? Does it depend? Some of it's in-house, other countries' regions are outsourced. Do you mostly outsource everything, or you're really not sure how the compliance is by your department? So if we could start, putting in some votes on that to see where that's at, we were just curious to understand that.
Yeah, we have a big interest in that, because one things that we're seeing that a lot of customers, particularly here in the U.S., are moving from an in-house, right, Larry, to more of a managed services or an outsourced resources, because for a couple of reasons. One is they want to continue to attract great talent. And so they feel like if they want to keep their talent or actually attract and retain talent, that they're looking for them to, they want to try and get that compliance obligation outside of the tax department. And really what you're responsible there for is just providing clean data to the outsourced provider. And most of the outsourced providers, they can provide stuff at a fairly reasonable rate in terms of filing your returns. So.
All right, so let's look at these results. All right, so we're dead even on mostly outsourced and in-house. That's great. And then it depends. I could see that happening too. That's a higher amount. That's pretty broad. It could be in different countries. It could be outsourced. So yeah, that's good. And 14%, not sure. Yeah.
Actually, Larry, that looks pretty normal from the polling that we've done with others. Yeah, it does. It looks pretty normal.
All right, Mike, we have like 6 minutes left, so let's have you go through these legislative updates.
Yeah, sure. So I wanted to get to a couple things, and then Larry, if we've got some questions at the end, we'll try and take those as well. And we do want to get to the last slide, which has additional resources. So a couple things, items 1 and 2, I just want to let you know that the granularity here in the U.S. will continue. So when we say granularity, the locals, cities, counties, districts, you're going to continue to see them increase their rates or actually implement rates simply because they have inflation costs, and they just have they have a way that they have to raise the funds for their operations. I think most of the folks on the call number 3 should look pretty normal to you. So fees will continue to proliferate here in the States. Right now, we support about 1,400. And so that is going to be something that we're going to continue to see. The base for the sales and use tax is basically at a 60-year low. And so what we're trying to just mention to you there is that that just means rates are going to continue to climb here as well. There's a question that came up around digital goods and services. There's a uniform act that's probably going to be promulgated sometime in 2026 around how you tax digital audio, video, distance learning, those kinds of things. So that should be a uniform act that should be coming that will actually be, quite a good item to actually give a lot of guidance. And that act will probably be adopted by most of the states. Larry, we know on item number 6 that audit activity is back where it was before pandemic levels. So you need to be aware of that. On incentive funds, most of the times, if you're either expanding some physical presence, either with a manufacturing plant, with office space, with significant sales offices, normally you can approach the state, the Department of Revenue, and there are incentive funds available for you to provide either some kind of property tax relief, or if you're purchasing a bunch of items, computers and things like that, and you're putting those in place, you get sales tax relief on there. So, and there's still money available for that. So anytime you see that, make sure you do that. And in terms of the budget pressures, those will continue at the local level, given the falling values of commercial office property. And then the last thing, one of the things that's happening is this, and one of the things is what's happened here in the States over the last 5 years is home values have just gone to almost record levels. That means property taxes have gone to almost record levels. And now a number of states, places like Florida and some states in the Midwest, are starting to look at trying to provide some relief in the fact that property taxes won't escalate, or they can only escalate a certain percentage. And so what that means is that at the local level, particularly for cities, counties, and districts, if they're going to provide that kind of relief, then that just means the sales tax is going to have to go up, because about 70% at the local level of those jurisdictions, that's where they get their funding is from a property tax. And so the only place they can go is to actually increase the sales tax. So we're seeing that trend kind of develop. And that should take us through that one, Larry.
Okay.
Some additional resources. I do, like I told you earlier, if you want to follow us at the Vertex Chief Tax Office, we put about 125 pieces of indirect on a global basis too. It's not just U.S. sales tax, it's actually VAT. We have a couple colleagues who actually do a lot of writing, blogs, webinars, postings. You can go there and look and see what we have available. We do have 2 YouTube channels. Larry has one and I have one. They've been pretty successful in terms of the number of views they get. Larry, just if you would, a little bit on yours, please.
Yeah, so I've currently now I've put 6 of those out, and they vary from talking to subject matter experts on ERP systems, and I've talked with people on e-commerce, and I've talked to people in HR, and it's basically just a conversation that then gets to talk about how a tax professional handles some of these areas. So it's a pretty good program, 12 to 17 minutes. We have a lot of good followers to come there, so you guys could take an opportunity. It's Larry Live Tax Talk for Tax Professionals.
Thanks, Larry. And then on Mic'd Up, it's only about 3 or 4 minutes. I've also put out about 6 episodes. Larry and I put these out, what would you say, Larry, every 6 weeks, 2 months, something like that on that. And normally what I do is I just try and take a tax topic and just kind of boil it down into one thing. So for example, one of the ones I did most recently was on a U.S. federal sales tax and why it's not appropriate. I go into a little bit more detail than I did earlier in the program. So if you're interested in mostly US-based sales tax issues, just 3 to 4 minutes on those. And then remember what I told you earlier is if you meet the economic nexus standards in a certain state, you'll want to go to that website because it has state by state by state as to when you actually have to start collecting or remitting. Again, don't start collecting or remitting until you're actually required to under that state statute, and they're all different. Okay. I think with that, Larry, that's our affirmative presentation. Any other questions that you have there or not?
No, there's no other. There's a few that are on here, but we're kind of at time. I just want to put on here that, our exchange is happening in Prague on May 6th for our Europe operations. So this is on here if you guys want to look at the QR code or reach out to Vertex to attend this session. And then I just kind of want to thank everybody and turn this back over to Kelly.
Thank you both. That was great. We've had some great questions. Any questions we didn't answer today have been collected and we'll follow up by email. So on behalf of our presenters, thank you. This concludes today's webinar. Have a great day.